Is joining in. Michael, morning. Thanks so much for taking the time out today. Markets have been extremely weak. We've seen
Good morning.
We've seen quite a bit of a sell-off coming in on the U.S. markets. Oil price and the commodity sell-off also has been pretty intense. How are you reading all these cues as we count down to the FOMC decision?
Look, I mean, there's a lot of volatility going into the Fed meeting, but I suppose the Fed meeting is actually not that important. I think what's even more important for global investors is to slow down in China and the commodity sell-off. I mean, you mentioned oil. I mean, a lot of people historically have thought that lower oil prices is good for the consumer in the Western countries, especially the US. But I suppose now the sharp moves we're seeing in oil to the downside is to some extent pointing out the fear in the market about maybe even slower global growth going forward, while at the same time you've got asset prices in many markets which are still highly elevated, and whether potentially this could mean that, yes, next year, 2016, could be much more challenging. Because I think many investors are still positioned in their portfolio construction for a continuation of the late-stage bull market. The real question is, irrespective of what the Fed does this week, whether we are actually at the beginning of a bear market.
So that is the big question. And where do emerging markets fit into all of this, Michael? Because we're bracing for an impact here as well. A lot of exposure, of course, in terms of foreign loans, in terms of also what we might see in terms of asset reallocation around the world. How do you think emerging markets will be affected, particularly India?
Look, I mean, emerging markets already have been affected very strongly, and I think India, to some extent, is a bright star out compared to the others. I mean, even in the currency market, the consensus view seems to be that the Japanese yen and the Indian rupee are the most insulated from a potential Fed rate hike impact, and hence the potential dislocation in the currency market. But I suppose the real question is this: emerging markets have led the sell-off, right? Is now a sign that Western markets will follow? Because Western markets have been somehow very resilient because of the belief that there will be ever more quantitative easing. But now with the Fed potentially ending their easy monetary policy and raising rates at least a little bit, I suppose we see more divergences, and these to some extent could cause more capital market dislocation. I think the most prominent issue at the moment is the high yield bond market and the way that is unwinding at the moment. And that's the real question. Can it be orderly diswinding of high yield, or will it be more disorderly? And it looks like we potentially could see more volatility, because I think the high yield market is very, very crowded. I mean, too many investors have been chasing yield on weakening fundamentals, and that's potentially a risk that will come very center stage next year.
You know, the interesting bit out here is what's happening on the currency bit as well. You know, we've been talking to a couple of the local voices back home as well, and they've been pretty worried about as to how this entire yuan devaluation fear again could really play out. Because in September itself, just a few months back, you've seen the markets tank on the back of these worries once, what we'd seen. Is there now another fear just emerging as far as what's going to happen in regard to the yuan and how things could then play out?
Yes, I think, China, I mean, everybody talks about the Fed. I mean, the Fed being the key market driver, but I personally think it's much more China that is a key driver. I mean, the fact of the belief rather that China could see more challenges, and also that China locally has a lot of issues that are potentially harmful to capital market confidence. And I think this potentially could play out in the Chinese fixed income market. The equity market in China already had a major correction. I think the fixed income market in China is still holding in. I suppose once the Fed raises rates, I think we could see some pressure on Chinese bonds and Chinese fixed income markets, and also potentially more weakening of the Chinese currency, which then again, I think that could be the real issue, then have a knock-on effect on other Asian currencies.
Okay. So then in regard to the way the outlook could really play out in 2016, Michael, what are your expectations? Are we likely to see some bit of a rebound? Are you likely to see more pressure coming in terms of emerging markets? How do you see 2016 panning out for a couple of the emerging markets in India in that?
Look, I mean, I think, the market is, again, opinion is always very divided. And I suppose this week should be key, because I think on the 18th, end of this week, there's like $1.1 trillion of options expirations coming out after the Fed meeting. And should we see more of a sell-off into the Fed and even after the Fed announcement, then potentially we could see some stop losses being triggered that potentially could could accelerate any move we could see. We could also potentially see a move to the upside because there's a lot of option expiration that need to be covered on the 18th. So this week could be quite challenging and highly volatile. Again, going into 2016, I think that most probably investors have to lower their return expectations. And that would mean that to some extent you need to be more selective because many people are still positioned for the continuation of the late stage bull market. What if this 2016 could be a bear market? And I think many people are not positioned for that yet. So once that realization sinks in that potentially we could be at the end of this multi-year expansion, then potentially we could see more move to the downside, in my opinion.
So then what, in terms of an asset class strategy, is it best to then stay in cash for 2016? Is that what you've been recommending? Or you would probably look at some of the fixed income or the bond markets to probably take some exposure there?
Yeah, look, I mean, with bonds, I think you have to be selective. But I think, look, if there is a dislocation in the fixed income markets, because I think investors are still very much mispricing liquidity in bonds. I think the recent sell-off in high yield made that very clear. I suppose in fixed income, I think it would be advisable to also reduce leverage because many people, because of the low yield environment, have borrowed money in order to go into fixed income. And in fixed income instruments, increasingly, they are illiquid. A lot of leverage potentially could lead to some disorderly unwinding. But I suppose in fixed income, it is about credit quality. Because if we see more weakening global growth and potentially a higher dollar across the board, emerging market countries and emerging market corporates might find it difficult to refinance. I think credit quality and credit risk, I think increasingly is the area to look into. More than just the macro, it's individual companies and individual corporate credit risk.
All right, Michael, let's see how 2016 plays out. Thanks so much for taking the time out today and sharing your thoughts and perspective on the markets and the outlook going forward from here. Michael Preiss there sharing his views in terms of what's happening currently and what one needs to probably watch out for in 2016.